Have you ever wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions, are able to trade in a fair and efficient environment, have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that acts as your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-check and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance, as it is imperative for investors to be well informed in the fast-paced financial world. Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules. Appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rule books of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Game Plan: What to Do After My Stock Drop in Prices. So, welcome everybody. So, my name is Shen Chu. I'm the moderator for this session. Now, when investing in the stock market, it is very common for us to face the situation where our stocks are showing capital losses, especially in bearish market right now. So it can be a difficult decision to make. Should we continue to hold our position? Should we cut our losses? Or is there any strategy that can help us to make the most out of our investment? So understanding what action to take in a situation of loss-making position is very crucial for any investor. And today we're going to explore what to do. Now, before we begin, as usual, disclaimer, whatever we share in this webinar is only for educational purpose. In no way will we give any recommendation for you to buy or sell any listed securities I mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He is a content producer of kclao.com. He has written over 300 articles and also being a regular webinar host and presenter on kclao.com. He is also the co-founder of Dividend Vault, whereby he transformed newbies into investors who can build dividend portfolios independently via education. So it's none other than Mr. Ian Tai. So Ian, how are you today?
Hello, Shane. Good evening to all of you. Doing great here. I hope the same to you too, Shane.
Yes, I'm doing well. So
Mm-hmm.
I will just stop sharing my screen and hand over the control to you.
All right, fantastic. So once again, thank you so much, Shane, for hosting this session. And of course, um, also would like to appreciate Bursa's effort in reaching out and giving me an opportunity to actually share a little bit of my experiences as an investor so that all of us can actually benefit from it. Okay, so as mentioned, this is actually my speaker's profile, but before I get into the content, let me also share with you my portfolio. So typically I do actually keep track of my own portfolio on a monthly basis, but of course I'm going to give you a snapshot of how my portfolio looks like lah. So as of December 2024. But as of now, April 2025, the portfolio in terms of the structure is actually pretty much more or less the same lah. So it doesn't really matter whether there is a Trump's tariff, no Trump's tariff, it doesn't really matter. The stock portfolio, the structure remains more or less the same. So the portfolio size is 6 figures, annual dividends 5 figures, geographical breakdown. So Malaysian stocks or Bursa listed stocks constitute around 20% of my portfolio. Singapore 75%, and US about 5%. Okay, so this is actually my current stats, my current standing as of now when it comes to my investment portfolio. So guys, today we're going to do a lot of calculation. So we'll appreciate it if you can actually prepare your smartphone, open up the calculator app, because we're going to do a lot of mathematics, a lot of calculation today. Okay. Now, today we are going to talk about the game plan. So, which is this: what to do after my stock drop in prices. So I guess the best thing to do for this session is not to go through theory, but to actually go into application straight away lah. All right. So let me just give you a question, and then we can actually start. So let's assume, that you had invested 50,000 ringgit into 3 different stocks: stock A, stock B, and stock C. Okay. Now let me just paint you the picture. What happened to these 3 stocks? So this is stock A. Stock A, you invested $50,000. So when did you invest in stock A? July 2012. So you bought this stock at $4, somewhere around here. So you invest $50,000 over here. And then you hold on to it. And right now, you are at this point in time, December 2016. Now it is trading at $3. Buying $4, now $3. So the value at this stage is $37,500. So therefore, your capital loss position at this point in time is 25%. So you're down by 25%. So this is stock A. Now, here is stock B. So stock B, what happened is that you bought this stock over here at $28 per share. You bought it in January 2020, just before COVID-19, just before the lockdown, the MCO. So after you have purchased it here, you held on to it, you ride through COVID-19, and right now, and at this point in time, which is December 2021, the price of stock B is at $21. So you invest $50,000 here. Now over here, the value of the shareholdings is $37,500. So your capital loss at this point is also 25%. Okay, so you are down by 25%, same as stock A. Now here is stock C. So stock C, you bought the shares over here at $11.35 in June 2019. This is a place where you invested $50,000 into this stock C. And right now, as it stands, as of September 2020, the stock price is at $8.50. So here, $50,000. Now the value here is at 37,445 ringgit. So therefore, your capital loss over here is 25.1%. Okay, so stock A, stock B, and stock C. Now the question is, what would you do? Type in the chat box, let me know. So after you have looked at these three stocks, I've actually just painted you the picture. All three stocks have dropped by 25% after you have purchased them. So what would you do? Would you be more interested to buy more of shares of stock A, B, and C? Would you just continue to hold on to them, which is hold on to shares of stock A, stock B, or stock C? Or you're the type that you just say, you know what, let's call it quit. You will either sell all of the shares and liquidate, or you will sell off partial of your shareholdings at stock A, B, or C. Okay, which means to say you kind of like sell some, but then you also keep some lah. All right. So let me know in the comment section, what would you do? All right. So let me just have a look. So Mike Cobb says hold on to A, B, and C. Thank you. Annie Lim, buy more. Ahmad says buy. KL Tan, depends on what A, B, C is. Okay. CS Huang, hold. Chu Hong says hold. William Tan says buy more of stock B. Eng says check on what is the outlook before deciding. Okay. Eng Seng Hock, buy more. Kennedy Buddha, hold and evaluate. Okay. So out of the many comments that I have received at the chat box, actually my personal favorite of the comment, right? I believe it belongs to KL Tan lah. So I like this short answer. Depends on what ABC is. Okay. And of course, the latest comment that is sent by Ong. Ong says, look at the fundamental first. Okay, so this is actually something that I will prefer to do first before I decide whether I should be buying more, whether I should be holding on, or whether I should be selling. Okay, so this session, I'm going to just review, if I'm in that position, what will I do? How will I react? Okay, so let's get into it. So now this is actually stock A, stock B, and stock C. It's the same diagram that you have just witnessed just now. So here's the thing. Okay, so if you look at A, B, and C, all I have reviewed to you just now are prices. So I give you stock A, stock B, stock C. You know, I also give you when I buy the stock and now what is the value of the stock. So at stock B, buy when, now at what price? Stock C, buy at what price? When did I buy? And now what is it trading for? So I only review to you price. Okay, so most people, when it comes to the stock market, they will actually see the price chart. They will actually look at price in order to decide. So if you happen to be one of those people, technically speaking, from the world of investing, we will actually put you in this category lah. You could be either trading or you could be speculating lah. Because traders and speculators tend to decide whether to buy, hold, or sell depending on stock price. Okay. Now, this is This is where investors, I believe, are different in terms of thinking, all right, in terms of mindset. So when it comes to investing, the decision made is actually not so much based on stock price. The decision is actually based more on stock valuation, okay? So it's not so much about stock price. Price is just one thing, but the more important thing is actually valuation. So what do I mean by that? Valuation means to say, in short, there are two main categories that we tend to actually think it in this way. We tend to program ourselves to think in two questions. The first one is what are the fundamentals? The second one will be what exactly is the valuation? So which means to say stock A, stock B, stock C, although all of them have dropped by 25%, but they can be of different situations, okay? And such situations will be depending on the stock's fundamental strength. So what happens is that if I'm looking at stock A, so from here to here, I'll be checking out its long-term earnings. How does the earnings figures look like over here? Then I will also look at stock A. So let's focus on the left-hand side of the screen on the price chart over here. So here, what I will do is that I will do a post-mortem. I will say that, hey, so July 2012, I bought the stock at $4. I want to know what exactly is the PE ratio over here. Now, December 2016, the stock price has dropped by 25% at $3, but I also want to know what is the current PE ratio over here. Same goes with stock B. I want to know what is the long-term earnings over here. I want to know what is the PE ratio over here, and as well as the PE ratio over here. Okay, so I want to know the past PE ratio, which is here, and the current PE ratio, which is over here. Same for stock C. I will also like to know what exactly is the long-term earnings over here, and then I will do a post-mortem on its PE ratio over here, and as well as the PE ratio. I want to know what's the current PE ratio over here. So from there, I can actually better decide whether I should buy, hold, or sell. So let's go through each of these situations one by one. Now let us go through stock A. So immediately, this is actually from Google Finance. So as an investor, what we do is that we look beyond the stock price chart. All right, so there's a context towards the stock price chart. So which means we don't just base on, oh, it has dropped by 25%. What do? We don't do that. So the first step, okay, as an investor, how will I react is that the first step is to actually take a look at the long-term earnings over here. So I want to know what exactly is the earnings figure when I buy the stock. Okay, I want to know what's the earnings figure here. I want to know what is the earnings per share, the PE ratio, and the average PE ratio over the past 10 years. All right, backdating 10 years over here. So this is where I do a post-mortem on its fundamentals and as well as its valuation. Then I will actually move on to this part. This part here, it represents a period after I have already purchased the stock. Okay, so after I purchased the stock, the questions I would like to ask is this: has the earnings of stock A, has it grown? Has it remained stable, or has it actually declined after I've become an investor, after I become a shareholder of stock A? So I want to know this kind of thing. Okay. And I also want to know what is the PE progression over here. And then finally, at this part over here, which is December 2016, when the stock price is $3, I want to know what exactly is the earnings here, the earnings per share, the PE ratio, and as well as the average PE ratio. I know there's a lot of things going on, but once you go through the whole case study of stock A, actually stock B and stock C, it will be easier. Guys, if you have any questions along the way, just feel free to type in your questions in the Q&A box, okay? So let's go through stock A. Now, the first thing that I will actually look at is not so much about the price, but it's actually on the long-term earnings of the stock. So this is how it looks like for stock A, okay? Now, take a look at this graph over here. So this is earnings. Figures are in millions of dollars. So we have the blue color bar over here. So the blue color bar here represents a period where I haven't become the shareholder of stock A. Red color is actually a period where I have already bought stock A and I'm now its shareholder. So this is before investing. This is after investing. So let's take a look at before investing. So before investing, here's how its earnings look like. Okay. So it started off with $257.5 million. It dropped to 138, but subsequently after that, 328, 465, 376, 350, 400, 380, 350, 400. Okay, type in the chat box. How many of you believe that based on these figures alone, actually stock A's earnings before I invest is actually doing okay? It's actually quite decent. Type in the chat box. How many of you think that? How many of you are okay with these financial results? If you're okay, just type in okay. If you type in not okay, then just type in not okay. So Mudit says lousy earnings record. Okay. So Eng Seng Hock says okay. You says okay. Chiu Hong says okay. So in general, most people are actually quite okay, quite comfortable with it. Fair enough. Okay. So stock A over here, the earnings seems to be okay. Now let's take a look at what happens after you have become a shareholder. So you're starting off here at 405. Then after you become a shareholder, the next year, he has recorded $391.1 million in earnings. Then after that, it recorded 328. Then after that, 362. Then finally, 308.6. So starting from a business that is making $406 million, after investing for 4 years, the company, Stock A, has actually delivered to shareholders 308.6 million. So guys, how many of you will be satisfied to see these financial results? Type in the chat box. If you are satisfied, yes. If you are not satisfied, type no. Type in the chat box, let me know. So Mundit says inconsistent, falling. Okay, not as so a lot of people say not satisfied. So KL Tan, not satisfied. Park Mei Yue, no. Jen Lee, no. Okay. Eng Woon Hui, no. Kevin Chong, no. So a lot of people say not satisfied. Okay, very good. So this is actually the first thing. So when I see this kind of thing, the first thing I will do is to investigate why this thing happened. So you have to read the annual report just to find out what exactly happened during this 4 years period. Why has it delivered a decline in earnings? Okay, but nevertheless, based on this chart alone, did earnings grew consistently? The answer is no. And over the 4 years period, it has dropped by 23.9%. Okay, so fundamentally speaking, its earnings, long-term earnings have actually declined over the past 4 years. Next, if you take a look at this earnings per share, which is not much difference as compared to its shareholders' earnings. So what happened is that we can actually plot this graph over here. So here we see that we're starting off with 30.4 cents. This is a time when you started investing, 30.4 cents. Now, as of 2016, the earnings per share is 22.9. So did the earnings per share grew consistently? The answer is no. It has dropped by 24.7% in 4 years. Okay. Next, so just now was step one. Step one is actually to take a look at its long-term earnings. Next step is to actually look into its valuation. So remember, it's always step one, step two. Step one, fundamentals, long-term earnings. Step two, valuation. Now let's take a look at this valuation. Okay, stock A. So we are using PE ratio as our valuation tool. So let's take a look. Blue color represents the period when it is actually before you purchase the stock. Red color is after you have purchased the stock. Now, this is usually how I will do postmortem. So I'll go back to the date when I purchased. Then I want to see what exactly is the PE ratio over here. Okay, so how do we calculate the PE ratio over here? So we have the purchase price, which is $4. And then we take the closest possible earnings per share, which is at 2012. So at 2012, your earnings per share is at 30.4 cents. Okay, 30.4 cents. So what you do is that we take $4, which is your purchase price, and you divide it by 30.4 cents. And therefore, over here, we kind of like have the PE ratio. So the PE ratio is at 13.16. Okay, so at this point in time, your PE ratio is at 13.16. Now, is 13.16 undervalue or overvalue? Actually, we won't know lah, all right? Because it's just a figure. So what do we do? Next is that we want to actually backtrack 10 years. We just want to see what exactly is the PE ratio over the past 10 years. From there, we calculate its average. From there, we kind of like know, oh, is 13.16 above average or below average? Okay. So here we kind of like calculate the part, we kind of calculated the historical PE ratio over the past 10 years, starting from 2003 all the way up to 2012. So over here, this period of time, we find that the average PE ratio is 13.87. Okay. Now, here's the question. You buy here at 13.16. Your average PE ratio is 13.87. So type in the chat box. At this time, at this stage over here, when you buy it at 13.16, average is 13.87. Is this overvalued, fairly valued, or undervalued? Type in the chat box. Let me know. What do you think? At this stage, remember you are buying it at in the year of 2012. So based on PE ratio alone, what do you think? So Bruce Lee says undervalued. Yes, it's slightly undervalued. You says fairly valued. Annie Lim says fairly because 13.16 seems to be very close to 13.87. So yes, you can arguably say it is slightly undervalued, but because it's too close, I guess fairly valued is also a fair comment lah. Okay. Now, before we go into the next slide, so currently, as of stock A, we have actually identified the fundamentals and as well as the valuation. So give me a thumbs up if you are okay, you are following this session very well. Just give me a thumbs up. Let me know that you are doing okay. And if you happen to be in a loss, type in at the comment section. Let me know also if you happen to be currently I'm digesting, I'm a bit lost somewhere. Just let me know whether you are doing okay or not too okay. Just put it in the chat box. Let me know about it. And without further ado, we just continue on. Okay. So CS Huang says okay. Zachariah says okay. Very good. Now let's move on. Now, just now we did the valuation as of 2012. Now at 2016, we will also redo the valuation. Just now you said we buy at $4. Now it's at $3. So $3 over here. So what's the PE ratio over? What's the PE ratio as of this time? So we get the latest earnings per share. And the latest earnings per share is at 2016. So the latest PE ratio is over here, which is 22.9. So this is the earnings per share. So at this point in time, the stock price of stock A is actually at $3. So what we do is that we take $3 divided by 22.9 cents. So this is how we get your current PE ratio, which is at 13.1. Now, how do we know that 13.1 is overvalued, fairly valued, or undervalued? Well, what we do is that we shift this 10 years, the latest 10 years period, right? So just now, so in 2012, the latest 10 years period is here. Now we have to shift it closer to 2016, starting from 2007 all the way to 2016. So as you can see, this 10-year bar has actually shifted forward to this point in time. Now, if you take the 10 years average over here, we find that the average PE ratio is at 13.68. So guys, type in the chat box. In 2016, is this stock based on PE ratio undervalued, fairly valued, or overvalued? Just put it in the chat box. Let me know about it. Okay. Let's see what responses that we can get from our audience. So Bruce Lee says fairly valued. So Ho Ka Sing says fairly valued. Okay. Fair enough. Very good. Very good. Still quite fair, huh? Okay. So now we have actually completed the post-mortem. Now we have more context to this drop in stock price. Okay. So we are going to put in the figures and we are going to continue our discussion. So let's say we have stock A. buy at $4. So we are starting off at 405.5 million in earnings. Earnings per share, 30.4 cents. PE ratio, 13.16. Average PE ratio, 13.87. Okay, so this is actually the stats, the context as of this point in time, what happened to stock A. Okay. And then from here to here, what happened is that, did the earnings grow? No. Did the earnings per share grow? No. So the PE ratio, what happened to it? It remains steady at 11 to 15. Now, over here at 2016, stock price at $3, earnings 2016, 308.6 million, earnings per share 22.9 cents, PE ratio as of 2016, 13.1, average PE 13.68. So guys, right now we have more context as to what happened to stock A. Type in the chat box, between fundamentals and valuation, what seems to be the problem for stock A? Why is there a drop in stock price? Is it because of fundamentals or is it because of valuation? Type in the chat box, let me know. What's the problem here? So Mundit says fundamentals is a problem. Very good. Correct. The answer is actually fundamentals. All right. Zachariah, fundamentals. Annie Lim, fundamentals. Absolutely correct. So the whole issue with stock A, all right, is not valuation. Because if you take a look at the valuation, PE ratio 13, PE ratio 13. All right, the whole time the valuation did not change. The valuation remains at 13 times the earning. All right, it can go high, it can go as high as 15, it can go as low as 11 times, but on average it's still 13. So no issues with valuation. But what's the issue here? The issue is really with the stock's earnings. It has dropped by 25%. Okay, 23.9%, 24.7%. And this drop in earnings, this decline in earnings has caused the fall in stock prices by almost the same magnitude, which is at 25%. So the whole idea here is that for stock A, the situation is that the fundamentals of the stock has deteriorated. Okay. What happened is that earnings have declined. Okay. So this is what I will do when the stock's fundamentals have actually declined. Typically for myself, when I build my portfolio, as an investor, as a shareholder of a company, what I hope most, what I actually invest for is actually income. All right. Income means earnings. Income also means dividends. You want the company to earn more and more money. You want the company to deliver increasing, consistent increase in earnings. And with the consistent increase in earnings, the dividend income will also consistently increase. However, when it comes to buying a share, buying a stock whereby its earnings have actually declined over time like this, so this is an issue of fundamentals. It is actually reflected with a prolonged decline in earnings. So in this case, what I will do is that I will sell. So if I see there's a problem with the fundamentals of the company, I will usually sell. Okay, so that is actually what I will do. Okay. Now, the question is this: what happens if I don't sell? So this is stock A, and this is actually what happened to, and by the way, these are, although I don't reveal the actual identity of the stock, but these stocks are real, by the way. It's not just fictitiously plucked from somewhere. It is actually really the actual earnings, actual figures of its earnings. So now this is what happened to stock A if, let's say, I don't sell. So over here, what I'll do is that I will decide to sell. But from here onwards, what if I don't sell? If I don't sell, this is actually the amount of earnings that stock A has delivered over time. From 308, it drops to 237, 233 million, 227 million, 133 million, 181 million, 160, and it has climbed back up to 218. But 218 is still below 308.6. Okay. So its earnings grew consistently. So over 8 years. So if I continue to hold on, for 8 years, earnings have actually declined. It did not actually go up. So guys, when you look at this kind of earnings, right, guess where the stock price will go? From $3, did it actually increase upwards, higher than $3, flat at $3, or it will drop below $3 at this point in time in 2024? So KL Tan says drop some more. Okay. Chow says drop. Eng says drop. It will be below $3. So KL Tan say, what stock is this? Cannot share lah, all right? You just have to accept that it is stock A lah, okay? So definitely it will. So most of you guys actually think that it will drop further. So let's take a look. So this is stock A. And guess what happened? If let's say you don't cut loss here, if you don't cut loss here at $3, the stock price actually continue to drop. And as I prepare the slide, the price, okay, the price is at $1.39. So from $3, so think about it. Take a look at the left-hand side of the screen. So you invested at $50,000. The value is at $37,000.50. So at this stage, you can actually sell off the stock and get $37,500. But you will realize a 25% loss over here. But if you don't sell, you keep holding on to it, all right, the stock price will drop to $1.39. The value of your investment will continue to drop even further, down from $37,500 to $17,375. And because of this, your capital loss is 65.3%. 65.3% after how many years of investing? After 13 years of investing, 65.3% capital loss. Terrible, isn't it? So if you think it's terrible, just type in terrible. Let me know about it, okay? So here's the thing. If let's say the fundamentals of the stock is deteriorating, and it has deteriorated for years, okay? Even though there's a capital loss, it's best to cut loss and sell off, recoup your capital and invest somewhere else, rather than to hold on to the stock. And as long as the stock continues to report declining earnings, then that's the story lah. Then that's the story of your money lah. It will actually continue to flush away down the toilet. Okay. Next, we're gonna look at stock B. Right. So let's take a look at stock B. Guys, a lot of questions coming in, so put it in the Q&A box so that I can address them after this webinar session. All right. So now let's take a look at stock B. Okay, same formula, stock B, but I'm just gonna re-explain the situation. You bought here at 28 January 2020. Now it's at December 2021, $21. So the question is, what are you going to do here? Are you going to buy, hold, or sell? So two-step question, fundamentals, valuation. Let's get on to it. Okay, so this is what happened to stock B. Blue color represents the period before you buy the stock. Red color is after you have buy the stock. But do know that red color, if you take a look at let's start off with the blue color first. Let's start off with the blue color. So blue color, stock B earnings, it has increased over time from the $130 million level, increased to 185, 200, 209, 210, and right now it reached 313. Okay. So did stock B's earnings grew consistently? The answer is yes. From here to here, or should I say from here to here, it has grown at a rate of, it has grown by 68.7%. Okay. Anyway, there's a good growth over here in earnings. And after you have invested in the in the stock. As of 2020, the earnings have actually dropped from 313 million to 154.2 million. But of course, understandably, you know that this is actually due to COVID-19. Okay. Next, take a look at its earnings per share. Did the earnings per share grow consistently? The answer is yes. All right, it has increased from 40 over cents all the way up to 103.3 cents. Okay, so there's a good growth over here in terms of earnings. But understandably, due to COVID-19, earnings per share or the EPS for 2020 has dropped to 51 cents. Now, let me just change the slide a little bit. Okay, so earnings per share 2020, 51 cents. Fantastic. You know what? Let me also just change this. EPS. Okay, let's get back onto the slideshow. Let's continue. Okay, so this is the fundamentals for stock B. Good growth, but then impacted by COVID-19. Okay. Likewise for earnings per share, good growth over here, and then here got impacted by COVID-19. Next, let's take a look at its PE ratio. So PE ratio, at this point, this is actually a time where before you actually purchase the stock, you bought the stock at $28, earnings per share is at 2019. Earnings per share earnings per share at 2019, $1.33, okay? $1.033. You take this, divide by this, your PE ratio at this point in time is 27.11. But you have actually done your homework. Let's say you're doing your post-mortem. You backtrack it for the past 10 years, from 2010 to 2019. The average PE ratio is at 20.6. Okay, so from here to here, the average is 20.6. But you found out that as you are doing your post-mortem, your PE ratio over here is 27.11. So guys, type in the chat box. Okay, is 27.11 PE ratio overvalued, fairly valued, or undervalued? Type in the chat box, let me know. What do you think? So Bruce Lee says overvalued, Ho Ka Sing overvalued, Annie Lim overvalued, Sam Ramasamy overvalued, Kennedy Buddha overvalued. So Kringo Hao overvalued. All right, thank you so much. 2020, so the PE ratio here is 45.14, but usually you don't take this very seriously because it is actually a figure impacted by COVID-19. All right. Next, let's take a look at its stock price over here. So I've already jumped the gun a bit. Over here, you kind of like omit this PE ratio because this is actually kind of like impacted due to COVID-19. So you kind of like omit the earnings and EPS for 2020 due to abnormalities of COVID-19. So what you do here is that you take $21, you decided that, okay, I'm going to just take the latest possible EPS, earnings per share, before COVID-19. And that would be 2019 EPS, which is at $1.033. You take 21, you divide by 1.033. Now your PE is at 20.33. Okay. So at this stage, when this stock B, the price is at $21. Okay. The PE is 20.33. Now we are going to compare this with the average PE from 2010 to 2019 because we are going to omit to 2020. All right. So let me just adjust this 10-year bar. We are going to just bring it back here as we're going to omit 2020. Now, based on this PE alone, 20.33, the average PE is 20.6. So at this point, at $21, is this overvalued, fairly valued, or undervalued? Type in the chat box, let me know. Okay, so currently right now it's actually fair. Okay, now let's let's do a summarized version. Let's do a whole complete picture of stock B. And from there, I will ask you a few more questions, yeah, about what's the situation like for stock B. Okay, so this is stock B. Starting off, so you buy here at $28. Okay, so you know that the PE ratio is 27.11. Average PE 20.6. So a lot of you guys say that, hey, at this time it is overvalued. Now, this period of time, did the earnings grow? Obviously not, because it was impacted by COVID-19. So because it's an abnormally, so therefore we kind of like sideline that figure because it's an abnormally, all right? Because usually as an investor, what we want to do is that we want to buy a business. And how do we assess the business income generating ability? We want to assess its ability based on how much money it could have made under normal business condition, not during a time where it has abnormalities like Trump's tariffs, like financial crisis or COVID-19 and all this kind of stuff. Okay, so you kind of like eliminate those factors so that you can actually have a much better assessment of its valuation. Now at $21 in December 2021, what happened is that you decided that, okay, I'm gonna just use back the earnings for 2019, which is 313.0, same earnings per share. Oh, let's change this. Okay. Same earnings per share, but now the PE ratio has dropped to 20.33. So the average PE over here is 20.6. Okay, now type in the chat box. What seems to be the problem for stock B? Okay. Is the problem more towards the company's fundamentals, or is it more towards the company's valuation? Type in the chat box. What seems to be the problem right now for stock B? So Earn Woon Hui valuation. Okay, so Annie Lim has a more specific answer, which I kind of like, which is valuation when I bought the share. Exactly. So Zachariah, valuation. All right. Good. So Annie Lim has a good answer, which is valuation when I buy the share. So after you do this post-mortem, you kind of like, hey, stock B, when I buy here, the issue, not so much about its fundamentals, because why? If you take a look at its fundamentals, it is actually a company that continues to deliver consistent growth in earnings. Okay? Consistent growth in earnings, consistent growth in earnings per share. So any issues with the fundamentals? Not really. What's the problem here? The problem is when you buy the stock. Why? Because when you buy the stock, you bought it at 27.11 in terms of its PE ratio, and 27.11, you choose to buy this stock at 27.11 PE ratio, which is a lot higher than its average PE, which is 20.6. So this itself has revealed a weakness in terms of decision making. And the weakness is you kind of like bought it, a good stock, at a high valuation. You have paid a premium for it. You have overpaid for this stock already. So that is actually the main issue for stock B. Okay. So since you have identified the issue, okay, and it is actually based on, I kind of like make a mistake here. I have actually overpaid for this stock. Now, this stock is at $21. And you know that it is actually kind of like, the PE ratio now is 20.33, which is very close to the average. So the question is, at this stage, you already know the context, you know the whole story already. What would you do? Would you sell off the stock? Would you buy more? Or would you just hold on to the stock? Type in the chat box, let me know how would you do? How would you deal with this situation? So Annie Lim says start buying more. Yu Xiu Feng says buy more. Sam says hold, buy more, buy. Hold and watch closely. Hold on and buy more, buy more. Okay, so most of you guys says hold or buy more. Okay, thank you so much. Okay, so now here the issue is actually at valuation. More specifically, I like what Annie Lim has actually typed in. It is valuation when I buy the share. So the issue is not actually on the company. The issue is that I go and overpay for the stock. Okay. The issue is actually on the investor himself or herself. Okay. It's the investor's fault, not the company's fault. Okay. So now after you have done this whole exercise, now you kind of like know that, hey, it's my own problem. But after I did the whole valuation again, it is fairly valued. So actually, whoever who answered hold on is also correct, because you may have other stocks that you want to buy. So you can actually choose to hold on to it, or you can choose to buy more of the stock because you like the stock very much. So any of the two answer would be correct. At this point in time, there's no point selling in the stock, no point selling off the shares in the stock already. Now let's take a look at what happened if you choose to hold on, or you choose to sell, you choose to hold, or you choose to buy. What happened to this stock B, after you have made this decision? Now let's take a look. So this is stock B. So this is the time where you have decided, okay, it's time for me to either sell, hold, or buy. And now guess what happens? For stock B, stock B has actually reported the following earnings. 245.7 million. Okay. 412.8, 386.8, now 466.7. Okay, I haven't reviewed to you the stock price. So let me just give you a stats. Let me just give you a simple calculation. Did earnings grow consistently? The answer is yes. Over the 5 years period, from here to here, it has grown by 49.1%. Now, at this stage, let me just ask you a question. Question is, how many of you regret, not regret, how many of you are, because so many of you actually choose to hold or choose to buy. So at this stage, I haven't actually reviewed to you the price. What happened to the price? How many of you look at these financial results are okay, saying, hey, I'm happy to hold on actually. Oh, I have decided that I either hold or I buy. Now I look at this. Okay, fantastic. I'm satisfied with its financial results. How many of you are satisfied? Type in the chat box, let me know. Okay, so Annie Lim, very good results. Ng Seng Hock says, okay. Bundit says, this is good record. KL Tan, happy to hold on. Kennedy, happy to hold. Satisfied. Bruce Lee says satisfied. David Koo says satisfied. Okay, time for me to review the stock price. Okay, so this is actually what happened to the stock price after you have choose to hold on. Okay, so at this stage, all right, it's at 21. So now the thing is that you continue to hold on. Goes up, goes down. Right now is at, as I prepare the slide, it is actually over here, 26.28. So this is actually April 2025. Stock price is now 26.28. So here is actually what happened. Because of your decision to hold on over here, so either you hold on or you buy more, it will be different. So let's say you choose to hold on. What happened is that you bought it at 50,000. Here, the value has dropped to 37,500. But since you choose to hold on, right now it has recovered back. Now the value of the stock here is at 46,929 ringgit. Okay, so it has actually climbed back slightly. Now still your capital loss here is at 25% loss, but now you have reduced your capital loss to 6.1%. Okay, at this stage, how many of you are okay, can accept this kind of result? Type in the chat box. How many of you say, oh, I didn't actually continue to worsen or continue to grow my capital loss. Rather, I reduce my capital loss and I'm happy with it. Type in the chat box. Let me know what you guys are looking at. Okay. Regret if didn't buy more. Yu Xiu Feng, okay. Ng Seng Hock, okay. Fantastic. All right. Now, here's the thing. Here's the thing. Before I move into stock C, how many of you can see that stock A and stock B, very different situation? Type in the chat box. Different. The stock price may drop by 25%. Both stock A and stock B drop by 25%, but the situation is just totally different. How many of you can see the difference? Different. So as you can see, even by these two case studies, stock A and stock B, you can see that if you just base your decision on price, all right, oh, this stock dropped by 25, that stock dropped by 25. If you didn't look at its fundamentals, you didn't look at its valuation, you would think that it's the same. But actually, from an investor's point of view, it's not the same. And because it's not the same, you will react very differently. How I will react, how I will manage stock A will be very different from how I will manage stock B, because the situation is different. Now, let us move on to stock C, all right? Our final case study of the day. Let's take a look. So this is stock C, bought here at 11.35. Now it's at 8.50. We are going to go through the whole exercise all over again. Okay, I'm not going to just review I will just read out the figures. You tell me whether you're okay with it or you're not okay with it, all right? Let's get on to it. So this is periods before you buy. So you have found out that stock C, its earnings is as follow. It has increased from $1.49 billion all the way up to $4.49 billion. So this is before you invest. And after you have invested, from 4.49 billion, it has increased up to $4.96 billion. Okay, so this is the financial results. How many of you look at these financial results as are believing that, hey, stock C, the fundamentals are okay? If you like the fundamentals of stock C, type in the chat box, say like. If you don't like, also let me know. Just type don't like, okay? Like. Okay, fantastic. Next. So this is earnings per share. It's the same diagram, same pattern as we have seen in the earnings figure. So this and this same, but let me just read out to you. Earnings per share for stock C increased from 48 cents to 107 cents. This is before invest. After you have invest, it has increased from 107 to 113. So it's just 1 year increase. So this is actually what happened to its earnings per share. So why do we use earnings and then earnings per share? So earnings is to see the absolute amount of total earnings that the company has been making, but we convert it to earnings per share because we want to do valuation, okay? So that is actually the reason why we look at both earnings first, then we look at earnings per share. Next, we are going to look at its PE ratio. So when I buy the so this is stock C, not stock B, stock C. So PE ratio is here. When I buy, it's at $11.35. So based on its PE, it's at 10.61. The average is 11.99. So how many of you think that over here it is undervalued, fairly valued, or overvalued? Type in the chat box, let me know. Okay. So all the unders are coming in. Very good. Next, here is actually what happened. Now the stock price is at 8.50. Oh, this one I can change a bit. Now it is at stock A. Okay, share with you one trick. You know what? Forget it. Let's just live with this mistake. So this is stock C. Okay, so now we are stock C, 8.50. Based on your PE ratio right now, it's at 7.52. Average is at 11.21. Okay. So let's look at the whole picture. So this is stock C. Stock C, you're starting off here. Earnings 4.49 billion. Earnings per share 1.07. After 1 year, earnings at 2019 increased from 4.49 to 4.96. Earnings per share 1.07 increased to 1.13. PE ratio 10.61. dropped to 7.5. The average, 11.99, 11.21. So this is actually the picture. Now, type in the chat box. So what do you think is the problem here? Is the problem, is stock C the problem in terms of its fundamentals? Or is it because of valuation? Or is it because of other reasons? Type in the chat box. So Mundit says other reasons. Okay, fantastic. So at this point in time, right, other reasons. So at this time, let me just ask you a few more questions. Number one, how many of you think that buying stocks at this time at $11.35, buying stock C at this time is a mistake? How many of you think that this over here is a mistake? Type in the chat box. Yes, it's a mistake. Or if you think that it's not a mistake, just type in, no, it's not a mistake. Put it in the chat box, let me know. So Patrick Lim says, mistake. Mundi says, not a mistake. No. All right. Yu Siu Hong says, no. Ahmad says, yes. Sam says, yes. Ho Ka Sing says, no. Annie Lim says, no. HS Go, no. All right. So KL Tan says, at the point in time of buying, doesn't look like a mistake. Kennedy Budak says, no. CS Wang says, no. Now, here is actually another lesson for all you guys. So guys, as an investor, what we'll do is that we will actually assess the stock's fundamentals and as well as the valuation. Now, the thing is that the fundamentals may look okay, the valuation may look okay, and when you buy here, it doesn't look like a mistake, all right? And typically, as an investor myself, I also don't see any sort of issue buying stocks over here, okay? But somehow rather, no matter how right or no matter how an investment ticks all the check boxes, stock price can actually go down. So here, if you look, this is at 2020, it goes down. Why does it go down? At 2020, because of COVID-19 lah. So this is actually due to other reasons. So in this case, other reasons are classified as external events that all of us cannot control. Okay, external events that all of us cannot foresee, cannot control. It just happened. Despite doing all the right things, buying the stock at $11.35, it dropped to $8.50. And because of this, the PE ratio has dropped to 7.5. Now you know the whole picture already. At this point, how many of you will choose to sell off? How many of you will choose to hold on? And how many of you will choose to buy stock C? Type in the chat box, let me know. Who wants to buy side? Who wants to buy stock C? Who wants to hold on to shares of stock C? And who wants to sell off? Let me know. So a lot of people says hold, buy, Bruce Lee, hold, Go says buy, hold and buy. Okay, Ng Seng Hock says sell. KL Tan says must stop, must know what stop. Don't need to know one. You just need to know the fundamentals and the valuation you know already. So Chan Wee Han says buy to average down. Zachariah says sell. Okay, fair enough. Now here's what I would do at this point. To me, I just based on the company's earnings. Is earnings good? Yes. Is the how is the PE ratio like? PE ratio is at 7.52. It is actually quite close to the average, which is at 11.21. So at this stage, I will be more inclined to buy. Okay. But if I don't have money, I will just hold. I won't sell. Now let's take a look at what happened to stock C after this period of time. Now let's check out its earnings. Okay, so this is actually how its earnings look like. Okay. Starting from here, 4.96, it dropped to 3.69. So this is due to COVID-19. And after that, 4.96, 5.5, 5.85 billion, 7.12 billion, 7.65 billion. So from here to here, it is actually there's a consistent growth in earnings, except for the times during COVID. But from here to here, it is actually a growth of 70.2% in earnings. So guys, type in the chat box how many of you are happy to hold, how many of you have regretted to sell, or how many of you have regretted to hold, or how many of you are happy to sell. Type in the chat box after looking at this earnings figure. Let me know, what do you think? So KL says, wow, happy to hold. Sam says, regret selling. You says, happy. Annie Lim says, regretted, didn't buy more. So Patrick says, happy to hold. Okay, so how many of you make a guess? What happened to its stock price? Oh, don't need to guess. Let me just review it to you. What happened to its stock price? So here's what happened. Here you do all the right thing at $11.35, but because of external events like COVID-19, it dropped to $8.50. So therefore, you have a capital loss over here. So the capital loss is, let me just backtrack. Okay, we should actually use this figure. Let me copy this. Let me paste it here. Okay, slideshow back. Okay, so you started off 50,000 here, but over here it has dropped in value to 37,445 ringgit. So therefore, there's a capital loss here. But you decided to hold, or you can buy more. So let's say we hold or buy more, or you hold on to your existing shareholdings. From here to here, at this point, the value of your investment is now 68,282 ringgit. So instead of a capital loss, now you have a capital gain of 36.6%. Okay. So now let's take a look at this tree. Stock A, stock B, stock C. Stock A, what's the problem? Business fundamental. So because the problem is business fundamental, the solution is to sell. That's it. Stock B, the problem is with the investor. Buy when it is overvalued. So what's the solution? You have to revalue the shares. And if let's say the share is still overvalued, we can sell. If the shares is fairly valued or undervalued, we can actually choose to hold on to the stock. So that is actually the solution for stock B. As for stock C, the problem is not with the stock, not with the investor, but it is actually due to external events. Events that you cannot foresee, you cannot predict, and you cannot control. So when it is such events, which will happen in the future, okay? Because what is certain today is uncertainty, all right? So please do expect external events to happen. They will arise. So when those problems arise, so what's the solution? The solution is actually just relax and hold, or if you have any more capital, you can actually choose to buy more to top up onto your portfolio. So three different problems, three different solutions, but three different problems, three different ways of looking at things, three different outcomes, okay? Or you can say three different ways to tackle this, three ways of tackling this whole situation. So some key takeaways before we go into Q&A. So as an investor, we don't actually make price-based decision, but rather we base our decision on valuation. Now, ultimately, the main driver of capital growth still lies in earnings growth. So like stock A, earnings continue to drop. So because of that, stock price koyak lah, or the stock price actually continue to decline. For stock B and stock C, their earnings have grown over time. All right, it may drop, but that's very short term. But over the long term, because of its business fundamentals, the business earnings have actually grown over time. And because of that, stock price actually reflected such growth lah. So the main driver of capital growth continues to lie with earnings growth. And last but not least, so how do we actually make decisions? Well, from an investor's point of view, we make decisions based on three things. All right. So we have to actually check, is the issue lie with the fundamentals? All right. Or is it lie with the valuation? Or is it lie with external events? Different situations, different solutions, different outcomes. So with that, I'm going to just pass back the control to Shane, and let's do some Q&A. Thank you so much.
Thank you so much, Ian, for sharing with us your strategies in managing stocks that in capital losses. So, if any questions to ask our speaker today, please write your question at the Q&A box.
Mm-hmm.
All right. So, first question I
Yep.
have on my screen is from William Liao. How do you calculate your historical PE ratio? Do you use the date you bought and backtrack it?
Okay, so let's go back to the slides. So what happened is that first you take the earnings per share for every single year. Let's say you backtrack it for 10 years, right? So we have 2008, 2009, 2010. So what you do is that usually different investors will have different calculation lah. But the simplest way is that you take the closing stock price of 2008, divide by the earnings per share for 2008. So you get the so you get the PE ratio for 2008. You do the same for 2009, 10, 11, 12. So you take it for the latest 10 years lah. So what you do is that every now and then, what you do is that you will shift the 10 years to the latest or to the present. So that is actually how I do it lah. So that's how I do my calculation when it comes to historical PE ratio.
All right. Thanks, Ian. The next question from Sam is that do we minus the dividends from the capital?
No, actually for this webinar, right, actually you should I'm gonna just explain it from the capital gain and capital loss perspective. But then if you want to make it into total returns, you should actually include dividends. But it's just that because our time is just 1 hour, so I just want to share and make a clearer statement lah, a clearer distinction between the three different stocks, three different problems, and three different methods of looking at it lah. So that's why for the time being, I didn't actually include dividends lah. But technically speaking, you should actually include dividends because the picture will be more complete.
All right. Thanks, Ian.
Mm.
So the next question is from Stan Lee. I think this question is very relevant. Given the current bearish market right now, which is induced by Trump reciprocal tariff,
Mm-hmm.
so what would you do if the stock price dropped like 20 to 30% due to macro issue like this?
Actually, it's not what would I do, right? Because it's already Trump tariff, right? It's already like there, done, right? So now now post-Trump, or you can say during Trump's tariff issue, right? I didn't sell, all right? Because what I believe is that investing is about holding on to a stock where their business fundamentals are good. So as long as the business fundamental is good and it is income producing, good lah. So can actually just keep holding on lah. And since the stock price, let's say it drops by 20-30%, I will recalculate its valuation. And usually the valuation will be more attractive. If it happens to be dropping below its average PE ratio, right? Then I think that I may consider investing in it lah.
So you don't see this as an issue related to fundamental.
Not at all lah. So think of it this way lah. So like COVID-19, that's how I invest lor. So it's like I didn't try to speculate what might happen to a business because of COVID-19. Now it's the same thing. Of course there will be people who will try to predict, oh, what will happen to businesses after Trump implemented the tariffs. But I try not to predict too much lah. All right. So I just look at the business. As long as the business is okay, fine. The valuation makes sense, can proceed already lah.
All right. But the follow-up question from KL Tan is that the tariff will affect the profit, isn't it? Won't that affect the fundamental of the companies?
Yes and no lah. So like you just have, so like me, I kind of like we can actually draw a lot of experience from COVID-19 lah. So COVID-19 will the COVID-19 pandemic impact profits? Has it impacted profits? The answer is yes. How long? Maybe 1 or 2 years. So I guess the key thing here is to be patient for at least 1 or 2 years because you know that these are actually events that happen, and we just have to build a sustainable portfolio to actually withstand this whole thing. Just like COVID we just withstand it for 1 2 years, and everything is back to normal. Right now, once it's normal, there's another event, which is Trump tariffs. So again, it's just a matter of being patient, have a good game plan, and just stick to your game plan. So that's actually my take on how to actually invest during times like this. Actually, think about it this way. Uncertainties in the stock market, right, is actually very good for investors. What? Trump tariffs financial crisis trade wars physical wars and all this kind of chaos it's actually pretty good for investors. All right. You know why? Because if, let's say, everything is predictable, everything is certain, okay, everything is bright, everything is very promising, everyone believe that, wow, earnings growth is going to go, earnings growth of a company will actually just go up, everyone can see the money, what will happen to the stock market? What will happen to all these fundamentally strong companies? Their valuation will be not so attractive because everyone will verbal for it . However, during chaos times, during times of doubt, during times of uncertainty, so this is where some people may actually drop off and say, you know what, I guess let's wait and see, maybe let's see how the situation will play out. So the valuation of these stocks is not as good as it should be . So this is actually where we can actually come in, and in Cantonese we say "zap" which means we come in and grab some good deals because of the murky waters, because of the uncertainties in the market. So uncertainties are good . It's actually a good, it presents opportunities to grab good stocks at a good price, at good valuation.
All right. So the next question is, what if recessions really happens out of this Trump-induced tariff that caused the recession? What is our game plan?
I guess the game plan is the same. I don't think I would change the game plan too much because of any I will consider that as an external event. So my primary goal is to actually accumulate good stocks, make sure that they are income productive, make sure that they are dividend paying and all this kind of stuff. So it's not like I'm gonna just change the game plan totally just because of Trump tariff . All right, so I'll just carry on . But since there's Trump tariff coming in and there's a lot of uncertainty, so I'll add one more layer to my criteria of stock, which is I will actually take a look at this balance sheet. I want to make sure that the company it's not just one that has generated consistent growth in operating cash flow, but one with some cash . All right. And not only that, I will also look at its debt level. Just want to make sure that the debt level of these companies are sustainable, or better still, no debt, unleveraged businesses . So I know that these businesses can actually survive and last through tough times . So I will actually use that as one extra layer of criteria just to make sure that my stocks can actually remain sustainable during these very tough times. Right, Shane?
All right, thanks, Ian. Besides stocks, how do you diversify your investment? Do you do it to other assets such as gold, oil, crypto, or even bond?
Not really also . All right. So technically, I'm very simple-minded. My whole focus is to actually accumulate as much income-producing assets as I possibly can. So what are the assets that can generate income? So it's just stocks or properties. So it's just these two . So it's just So I would say that most of my portfolio will revolve around these two lah. As for gold, silver, cryptos, so like cryptos, I do not know much of them. Gold and silver, know a little bit more about them than cryptos. I guess it's a good hedge of, I guess it acts as a hedge against inflation or hedge against uncertainty. So, but I don't have them anymore. So it's just stocks and properties lah at this time lah. Because at the end of the day, uh, I'm actually quite single focused lah. Income, investment is to produce income lah. And better still, the income must be growing on a consistent basis. So that's the objective. Yeah.
All right.
Mm.
But bond also generate income. What?
Yeah. I just didn't. But I guess you can also invest in bonds, but I like to own businesses lah. Let's put it that way lor. So you can be a debt holder lah, you can be a bond holder lah, but between bond holder and stockholder or shareholder, I prefer shareholdings lah
All right.
than being a bond holder.
The next question is by Modik. Do you also look at PEG or price to earnings alone is enough for valuation?
You can look at PEG. Because at the end of the day, PE is about valuation, but the G factor is actually very important. The G factor now, I believe, I will actually look more into the G factor lah. G stands for growth. So I will calculate the earnings growth of a company and then I will compare it with its PE lah. So if you are one of those people who want to invest for growth, you can actually compare both. PE ratio and growth, you combine them together, you will get PEG. So you can actually look at that. No problem.
All right. The next question is it not advisable to put stop loss at an acceptable level instead of keeping the position open and potentially losing more than the acceptable level?
So now we go back to this chart lah, that we see lah. Because let's say at stock C, so you see here, of course you can put a stop loss, but the thing is that when you are value focused, when you are more focused on accumulating good businesses, you don't care so much about the price. So when you're price focused, you look at this $11.35. Now it's at $8.50. Oh, this is bad, man. This is a terrible mistake. This is a no-go. So if you are a trader or speculator, then maybe you should put a stop loss. Okay. But I'm not a trader. I'm not a speculator. I like to accumulate. I'm an accumulator. So if I see that, hey, stock C is fundamentally a good stock, it drops by 25%, why do I want to sell here? Or here, why do I want to sell here? I may actually want to grab, buy, because it's of good value. PE ratio is at 7 plus, 7, 8 plus. Why do I want to sell at that point? I should be buying. And if I continue to buy like that, then my capital gains here will be even more handsome than I just hold on to whatever I have here. So how we think, what's your core, is very important. If your core is on trading, speculating, you're always thinking about price difference, then naturally you can't buy here. It's hard for you to buy here. But when you're investor focused, you are focusing on accumulating businesses. You're not so price focused. Your whole purpose is to buy and accumulate good assets. Then it's easier for you to buy here and achieve quite handsome the capital gains. And along the way, dividends as well. Your dividend use will be a lot better. Your capital gains will be a lot better. So that's the two schools of thought lah. So it depends on how you guys decide your core is lah.
All right. So do we still rely on the past valuation average for turnaround and cyclical stocks? Is it applicable for businesses that pivot or expand on the business models? So that's a question from Mike.
I don't do turnaround. I don't do cyclical because I believe that, because I'm not that kind of people lah. There are some people who are doing turnarounds and cyclical lah, but I'm not one of those people lah. So mine is actually, you can say, quite simple lah. I like to accumulate stock C kind of businesses. I just like to do the simple stuff lah. Simple stuff, very boring. Nobody talks about it. Beautiful businesses. Hopefully the news coverage, no influencers, no YouTubers, nobody talk about it, but it's beautiful business. That kind of thing I like. Then I just accumulate and keep and just go about my everyday life lah. So that's how I kind of like invest lah and build my portfolio. So turnaround, cyclical, no lah. I don't buy into them lah. It's for other people, but not for me.
Mm. So the next question is in regards to stock C in your slide, right? How often would you add more of stock C to your portfolio?
As long as the PE ratio is right lah. So which means to say you kind of like have a cap. So let's say you have you're not looking at price, you are looking at valuation. So let's say after you have calculated the average PE ratio. So let's say out of curve lah, the PE ratio on average of a stock that I like to invest is 15, for example. So as long as the PE ratio of the stock is below 15, doesn't matter whether it's under normal circumstances or there's a short-term event like Trump's tariff lah, pandemic, financial crisis and whatnot. As long as it's below 15, just buy lah. Just dollar cost your way lah. As long as it's below 15. Until it hits above 15, then okay, find another stock to dollar cost lah.
All
You
right.
can't run out of stock to dollar cost one. There will always be value in the market.
Okay. Yep. Annie would like to ask, what is the relationship between PE ratio and EPS? Are they the same?
PE is price to earnings, so price to earnings. EPS is you take the earnings, you divide by the you divide by the number of shares lah. So let's say, for example, you have a company is making $100 million in earnings, and then it issues out 100 million shares. So you take 100 million, you divide by $100 million divided by 100 million shares, you get $1 per share. Now the question is, how much are you willing to invest to buy that company that is earning $1 per share? So let's say it is $10, then your PE ratio is 10. So that's the fastest tutorial lah that I can give you on PE ratio and EPS.
Okay. Yep. Could you share about what is your biggest loss experience? Let's do this as a last question from Ming Yu.
Biggest loss, capital loss 40-50%. Biggest, it doesn't happen too often, but if you ask me about biggest loss to date lah, that is the biggest one lah. Yeah. So I bought a stock, not besar one. It's actually listed in Hong Kong. So I bought just one. So that one, everything looks rosy, everything looks nice and beautiful, but then it just so happened that it didn't work out lah. And after I purchased the stock, it has actually reported lower earnings. It's not to say it's not profitable, it's profitable, but decline in earnings because of certain events. And it doesn't seem that it is actually working. So I decided that it's time for me to get out lah. It's time for me to actually dispose the stock, recoup back whatever I can recoup back, and I have invested into another stock. And because of that, I kind of like recover back somewhat lah. At least to say my capital loss is not that bad lah, because of the dividends and the capital gains received from reinvesting from the capital recoup into another stock. Yeah. But the thing is that over a span of, let's say, almost 10 years of investing lah. So I kind of like make hundreds of transactions lah. Okay. Purchase like quite a number of stocks lah, here and there lah. I would say that out of this, how many stocks I have capital loss of 50%? The answer is just one. The second biggest loss is about 20, 30, about 30 plus, 20, 30%. Then the rest is like that loss. So I have two major losses, two stocks that have two big losses, but for most parts, no lah, no such events lah. So it's like running a bank lah, okay? It's like running a bank. You have a pool of borrowers. All of them seems to be credit worthy, but then there will be one or two that will give you a shock lah, okay? So these are actually non-performing loans. So all the banks have non-performing loans, right? But the question is, what is your ratio? How much is your non-performing loan ratio? Every 100 borrowers, how many default on you? So if let's say you have a credit policy where you implement it, every 100 borrowers, only one or two default on you, then fine. But if let's say you invest in, you kind of like lend to 100 borrowers and 50 of them default on you, then something is very wrong with your credit policy lah. So at the end of the day, for me, myself as an investor, there are losses. I don't deny them, but the thing is that how do you actually construct a portfolio so that you manage the risk well, so that your default lah or your losses, okay, can be minimized and you can actually increase your chances of success. That one is actually an art form lah. Yeah. So back to you, Shane.
All right. So
Mm.
that's the time we have for the Q&A session with Ian Tai. So thank you so much, Ian, for sharing with us your idea and perspective. How do you manage your positions that in capital losses? All right. So, ladies and gentlemen, you just listened to the co-founder of Dividend Vault, who is Mr. Ian Tai.